I don't think we're going to enter a very long period of serial underperformance of the US, but I think the years of consistent, dramatic outperformance, which in part was led by the large tech stocks dominating the US market and also a consistent rise in the dollar, these things are beginning to shift, and we would continue to recommend more diversification.
But how can you do your job or understand that path ahead when so many companies are pulling their guidance and themselves are so uncertain? I mean, think Mercedes and Stellantis just today, but the path ahead on tariffs is really unknown.
It is, and I think this is what really makes the rally that we've just seen still quite fragile. The market's implied risk of recession has fallen, and that's partly, of course, because the Trump administration has pulled back on some of the most punitive tariff announcements that it began with. But on the other hand, it's still not very clear whether the tariffs that remain, and particularly the embargo, as you said, between the US and China, have already done enough damage to generate a recession. So far, the soft data, the survey data, has been deteriorating quite sharply as these uncertainties hit consumer confidence, investment decisions, and so on. But as yet, that hasn't really been confirmed in the hard data, or indeed, as you say, in the actual earnings numbers. But we have to recognize that these are somewhat historic. They're covering a period before these tariffs actually were announced. So I think there's still likely to be quite a lot of volatility in markets, and really what's going to determine the path from here in the short term is whether we see a recession priced again or not.
Do you see a recession?
I think there's a good chance of it. Our economists in the US, for example, put a probability of around 45% of recession over the next year. But if we get the large tariffs that currently exist between the US and China continuing over the next few weeks, the chances of that recession will certainly increase.
So by extension, do you think the market's underestimating the risk of further earnings downgrades in the near term if you start to see that economic impact?
Yes, I do. I don't think the markets are priced now for a recession. If we take the US, for example, which came into the year with a price earnings ratio based on consensus estimates of nearly 23 times. Of course, it did fall. It hit a sort of bear market, having declined by pretty much 20% at its worst point. And that got down to a P of about 18. Since then, we've seen a rally of around 12% from the trough. And that's taken the P back to about 20. That valuation is not, I think, consistent with a recession, if indeed one comes through or investors begin to worry about one again. So I think it's too early to say that we really have seen an inflection upwards that's sustainable.
Which sectors are going to be best positioned here in Europe? I mean, we've seen huge increases in defence stocks, for example. Yes. The banks have done reasonably well in the last quarter from the volatility. I mean, there's even the idea, I was speaking to the CFO of AstraZeneca yesterday, that maybe pharma would be one of those areas to see increased spending, for example, from governments. It was something that Pascal Soriot has talked about also. This idea of sovereignty is moving the needle in terms of spending. There's pressure to spend more on defence, maybe even in the pharmaceutical sector. Which sectors in Europe do you think are best positioned now?
Well, I think there's two parts to this story. One of them, as you say, is what sectors are more defensive economically, because in a slowdown or potentially a recession, those that are less heavily geared to the economic cycle, less operationally levered, are likely to do better. And healthcare, pharmaceuticals, I think, would fit into that. And the second point is that actually more domestic exposed parts of the European market, which have been long under pressure because European economies have been weak, are actually looking more attractive. Partly as the euro rises against the dollar, that's supporting them on a relative basis. Those that are more globally exposed and have more dollar earnings are seeing an opposite pressure. But also we are seeing some fiscal expansion in Europe, led by the by Germany, apologies. And the prospects for interest rates to come down are still pretty good. And across Europe, including the UK, domestic savings, household savings, are unusually high. So all of that, I think, fits into more domestic exposure outperforming.